All right, let's just jump right into this explainer. Today, we're unpacking what is honestly the true engine room of the Indian stock market, the Nifty Small Cap 250 Index. If you've ever looked at the market and wondered exactly how the pros track those dynamic, high-growth companies flying just under the radar of the massive household names, well, you are definitely in the right place. We're going to completely demystify this benchmark.
We've got a lot to cover. We'll start by mapping out the broader small-cap universe, define exactly what the Small Cap 250 is, and check out the eligibility rules. Then we'll look under the hood at the calculation method and usage, shine a spotlight on some key sub-indices, and wrap up with why this all actually matters to you.
So, Part 1, the small cap universe, setting the boundaries. To really grasp small caps, we actually have to start with the macro view. The Nifty 500 index captures the top 500 companies, selected based on their full market capitalization. This is the bedrock. Basically, before a company gets sorted into a specific size bucket, it generally has to prove itself by breaking into this elite 500 club.
Just think of this number, 500, as the grand universe. It's the master list from which our small cap companies will eventually be filtered out. These are the top 500 most significant publicly traded companies in the market. But as we all know, not all of these 500 are created equal, right?
That brings us to Part 2, defining the Small Cap 250, or the bottom half.
The Nifty Small Cap 250 is quite literally the balance of the Nifty 500. Its whole purpose is to measure the performance of small market cap companies. It acts like a dedicated lens, zooming in entirely on one specific segment of that broader 500 company universe we just talked about.
And the crucial takeaway here is that this index tracks the bottom half of that initial universe. It completely excludes the mega corporations. It isolates companies ranked from 251 through 500. So by slicing away the top 250, your large and mid-cap segments, we're left with a pure, highly concentrated portfolio of 250 smaller companies.
All right, Part 3, eligibility rules, making the cut. Getting into this exclusive club isn't random. There are some pretty strict logical steps. First, a company has to be fundamentally solid and liquid enough to make it into the parent Nifty 500. Step 2, and this is equally important, they absolutely cannot be part of the Nifty 100 Large Cap Index or the Nifty Mid Cap 150. By satisfying those conditions, they slot perfectly into ranks 251 to 500. It's basically a very elegant process of elimination.
Let's move on to Part 4, method and usage. Looking under the hood. Now this is where it gets really interesting. The Nifty Small Cap 250 uses the free float market capitalization method. In plain English, the weightings of the companies are driven purely by the shares actively available for public trading. It intentionally tosses out locked-in shares held by promoters of the government, so it gives us a much more accurate, real-world picture of the tradable market.
And because this free float method perfectly captures that tradable small cap segment, financial pros use it for a ton of critical functions. Active mutual fund managers use it as a benchmark, while passive investors use it as the blueprint for index funds and ETFs. It's essentially the foundational architecture for small-cap investment products across the board.
On to Part 5, Sub-Indices Spotlight, exploring the highest turnover. So say hello to the Small Cap 100 and Small Cap 50 derivatives. These two hyper-concentrated sub-indices extract the absolute most prominent, highly traded companies straight out of the parent 250 index. They're built for investors who want that small cap exposure, but with a much tighter focus on the highest average daily turnover and market cap.
When you break down the sector representation for the Small Cap 100, the narrative is super fascinating. I mean, you might expect small caps to be totally dominated by aggressive tech startups, but when we look at the numbers, we're seeing a massive weighting toward financial services at over 31%. That's followed by healthcare around 13% and capital goods at 8.5%. It really shows that smaller regional banks, specialized financial institutions, and specialized manufacturers are the true backbone here.
And at the absolute tip of the spear, in the hyper-concentrated Small Cap 500, you'll find the specific heavyweights driving the performance. Companies like Navin Flooring, Karur Vysya Bank, Sona BLW Precision Forgings, and Delivery. Each of these guys holds the highest weightings, sitting at around 3.5% of the entire index. These are, without a doubt, the current heavyweight champions of the small cap arena.
Finally, Part 6, Why This Matters, the Historical Perspective.
Why does all this matter? Well, it's the historical context it gives us. The Small Cap 250 has a base date of April 1st, 2005, with a base value set at exactly 1,000.
By tracking these indices from that 1,000 mark nearly 2 decades ago, we can accurately measure the massive, long-term wealth creation happening in India's smaller, high-growth sector. It's a standardized ruler to measure grassroots economic vitality.
And that actually brings us to our final thought. The market is always moving, what index providers call price drift, so these weightings are never static. These companies are in a constant dogfight to grow their free float market cap. Every time the index is rebalanced, we have to ask ourselves, looking at the data today, which of these small cap champions is going to outgrow this index and graduate to become the mid-cap giants of tomorrow? Keep an eye on the numbers, because the data literally never stops moving. Thanks for tuning into this explainer.